So in the COVID era, there were a lot of changes to the tax code and the subsidies for health insurance, so on and so forth. And then when Trump was reelected, he came up with the One Big Beautiful Bill. We've done shows on that. But you might remember the Secure Act. Remember that one? Secure Act 2.0? It changed the way people can save for retirement. And just now, September 2025, the IRS has finally come up with some specific guidelines about that rule from years ago. So we're going to talk about the specific rules that the IRS has updated on 401k contribution rules, the catch-up contribution rules. Speaking of ketchup, Tony's favorite condiment puts ketchup on his ketchup, from what I hear.
No, I don't. No, in fact,
Tony,
no ketchup on hot dogs. Mustard only. That's the rule.
what about relish? Sauerkraut?
Yeah,
Okay.
sure.
So, you remember the Secure Act? We did shows on Secure Act. Put it up there if
2.0.
you want to watch.
Yeah, Secure Act
2.0,
and Secure Act 2.0. I love it.
right? Seems so long ago. And part of that was they added contribution catch-ups or catch-up contributions for people that were older. And that starts at age 50. So this is relevant to people watching this show who are still working and able to contribute to a 401k. They are probably in that age range where they can add more. Well, the IRS just came out with specific guidelines about those contributions that are considered catch-up contributions and what the limitations are, because you kind of add it to Roth, traditional, your choice.
Yeah.
Not anymore. New rules. All right. So let's back up and talk about what these catch-up contributions are.
Well, wait, Dan, first, before you talk about the specifics, and that's what our listeners want, but somebody once recently told me that talking about 401ks or 401ks, things like that, that's boring. Somebody said 401ks are boring to me. That person, I don't know, Dan, because what's boring about how would you like to enter retirement after you stop working and have hundreds of thousands, if not millions of dollars? I would. And so I think 401ks are anything but boring. They're exciting. And we need to know the rules so we can maximize 401ks. And the majority of people I know have 401ks or something similar, a TSP or a 403b. What do you think about that?
I think I'm waiting for the punchline because the way you positioned that commentary, Tony, I was waiting for a joke to happen. I thought you were going to say my 401k looks like a 201k, but actually it's probably
bump.
Yeah, it's not boring. It's very critical, especially for
Right.
people. You know what happens is most people don't retire not because they don't want to retire. They want to. They don't want to work anymore. They don't think they have enough money saved.
Right.
And they're usually wrong. They probably
Right.
do have enough,
Yeah.
but here's a chance for them to add more. And however, this little I don't know. We'll determine whether or not I like this at the end.
Okay.
I'm not going to go on a rant about the IRS rules. I don't like the IRS, right? But let's talk about what this is changing. What is first established? Right now, you're allowed to add to a 401k, and the max contribution in 2025 is 23,500. That's it. That's all you could contribute to your 401k.
Yep.
However, if you're age 50 or older, you can add an additional 7,500. So that puts you at 31,000. I'm not even going to ask you to do the math, Tony.
Oof.
So that's the catch-up contribution for age 50. The Secure Act allowed a super catch-up. Super catch-up. We should have graphics for this.
Yeah, we should.
Have a lot of fun with it.
Super ketchup.
Just throw a tomato at the screen.
Yeah.
Boom. Age 60 to 63, you can catch up 11,250. Don't ask me why they come up with these numbers.
Oh my gosh.
So
round up or down, please.
Right. So now we're at 34,750. If you're 60 to 63. If you're 64, you're back down to 7,500. Don't ask. All right. Not to be confused with the traditional IRA or Roth IRA catch-up contribution additional bonus of 1,000 once you're age 50,
Yeah.
or the health savings account 1,000 extra at age 55. This is specifically for 401ks, employer sponsored plans.
Yeah.
Certain, right? There's a difference between an employer sponsored plan and your own individual retirement account. So that's the baseline. And that's what the catch up contributions were. But the problem was, and I don't know if it's a problem, but people were asking, and accountants are asking, can the contributions be in a traditional 401k or a Roth 401k or some combination of both? And that was never really clearly stated in the Secure Act.
Of
So
course not.
finally, the IRS has gone around to it and they've established the rules. So the rule is, Tony, that the catch-up contributions made by people with income higher than 145,000 from that employer must be designated as after-tax Roth contributions. So your 23,500 base can be in a traditional 401k or a Roth 401k if you want. But the catch-up contributions, if you make 145,000 plus, have to be Roth. You can't put it in traditional.
Okay, that's an interesting little twist. But what about those under 140? What if I make 135,000? Can I then still do the extra catch-up contribution and put it into my traditional 401k?
Yes, you can. So
Okay,
then the question becomes, well, which do I put it in? Do I put it in the traditional? Does your employer even have a Roth 401k? What if my employer doesn't have a Roth 401k? That's a
find a
legit
new
question.
employer. No, I'm kidding.
You can't add the catch-up
Yeah,
contributions if you make 145,000.
yeah.
What I'm required by law to put it
Interesting.
into the Roth 401k. Well, we don't offer that. So what do I do?
Yeah.
You know?
Well, that's where
I,
you know what the answer is: work with a trusted financial services professional who's a fiduciary, who's going to look out for your best interest and help you decide which is better for your personal situation. That's the answer.
True. But what can I do if you come to me and say, "Hey, my company doesn't offer a Roth 401k." You want me to go up there with a picket, a sign and pitchfork, "Hey, hey, no, we won't go until you add a 401k Roth."
You you could
You
open
know,
a Roth IRA.
you can open a Roth IRA, but the contribution limits are different for your
A
own Roth
Roth
IRA versus
versus a
a Roth
401k.
401k.
Yeah. Yeah.
That's the big kicker.
Sure.
So those that are making 145,000 or more are typically the people that are maxing out their contributions and adding the catch up anyway. So they're the ones that are going to be forced into the Roth. And this starts in 2027.
Oh.
But the IRS is saying if employers want to make a good faith effort in 2026, they can force all catch up contributions into a Roth 401k in 2026. But they're giving some flexibility. So what does that mean? 2025 contributions catch up can be put into traditional IRA 401k. 2026, maybe if your employer allows it, you could put it all into traditional 401k. But in 2027, the choice is made. The rule is set. By the way,
Interesting.
for those that want to read the Federal register.gov documentation on this, you can read it. It's pretty short. I just like
Exciting.
to source my
Exciting
IRS.
stuff, exciting reading. Very similar to, say, a Stephen King novel. If you want to go to
Yes.
read federal documents. Thanks, Dan, for that link.
Yes. I look at the IRS as Pennywise. Is that it? The
Pennywise from
clown?
It. Yeah.
Yeah,
Didn't your
I see
mom
them
work
on.
for the IRS?
Yeah.
I mean,
Yes.
you talk
She
about how
did.
much you hate her employer. I love that. That's great.
She did too.
Well,
Well, she
sure.
worked there.
Yeah.
So again, though, it comes down to the bottom line of do you contribute to a Roth 401k or a traditional 401k? For the ones that aren't in the catch up, that aren't above 145,000, or anyone before you hit that catch up limit and the 145,000, you can go into traditional 401k versus a Roth 401k.
Mm-hmm.
And all the IRS is saying is if you make above a certain amount, you have no choice on the catch up. But for most other people, you still have the choice. So what do you do?
And Dan, isn't another factor you have to consider before you decide that is the match. Now, it's changed over the last couple of years, but I remember when Roth 401ks were first being offered by employers to their employees, the only way you could get a match, that had to go into the traditional 401k. You had to contribute up to this amount to get the maximum match, and that's free money. So you, for sure, that decision is a no-brainer, and no matter who you are, what your situation is, you want to get the full match. So you want to look at the match rules too, right?
Yes. So you're right, Tony. I can't believe you just said that. You're right.
I'm gonna that's a soundbite. We're pulling it.
Right, we got to keep this one. Timestamp. The 401k match was always into the traditional because that's all that existed. When the Roth 401ks came about, the match always went to the traditional because there was no taxing mechanism for the company to pay the taxes and then contribute.
Yeah,
They'd
the
always just
company
been
gets a tax break on the match with the traditional, but they wouldn't on the Roth, which was the initial. It's more profitable for the company. The IRS would allow it, but companies didn't do it because they don't. It costs them more. They don't get the tax advantage, right?
right. And from what I can tell so far, the ability for the match can go into a Roth, but I don't know if any companies are doing it because the
Yeah,
tax implications are complex for
yeah,
them. And they're
yeah.
just like, we're just putting it into the traditional. So
Yeah,
you
that's
can't
what
force
my
the company to
experience
do one
is.
or the
They're
other.
not. Most companies are not doing a match in a Roth. Some I've heard rumors that some have started, but
Mhm.
yeah,
It'll be interesting to see what happens going forward. Now, I will say you don't run into companies that are matching all. There's always a cap. So it's not like
well, sure.
someone's going to be getting um, their full catch-up contributions matched because they usually set a cap on what they'll
Yeah,
match.
so it really isn't a big deal because you can always just put enough to get the match in the traditional if that's the case. But your catch up is way more than that anyway, so you might as well
Right.
put it into a Roth if you can in some circumstances. Yeah,
Well, that's just the question, isn't it? And I agree with you that the match, putting the match in is a no-brainer. It is my number two investment vehicle. The corporate match is my number two retirement option.
and number
In
one
terms,
is the HSA.
yes, Tony's right twice in one day. I don't know. Maybe we
HSA,
should just
that
stop the
then the
show.
employee match because those are the most financially advantageous
Yes.
places to put
And
your
if you
money.
want to know why, watch the show we did on HSAs because I
Yeah,
do think that's better than even a 401k with a match. Now,
yeah.
going back to your question though, Tony, you're right. Um, well, is it a no-brainer to take well, let's take the match aside. Put that aside where I'm expecting down the road that the employers are probably going to have discretion. Maybe the employee can say, "Can you match it in the Roth?" I don't know.
Right.
But they're paying tax on it then. So that's going to be the tricky part. But what about for the most people that, just deciding, should I put it into the Roth? I now know the government, if I make so much, is forcing it into the traditional, the Roth 401k. But what about the other discretion that I have? And that's a really difficult question to answer. I cannot answer it for you, the listener, without knowing a lot of things. I'll just give you a few factors that show you how complex this can be. And I don't say it's complex just to make it sound crazy and that you have to hire a financial advisor, but it is complex in all the variables.
And
The
it gets
easiest
more
one
so
to know,
every time they pass something like the Secure Act or the One Big Beautiful Bill, these things all get more and more complicated.
that's right. And the Trump tax cuts were permanent, but permanent until when? Until the next Congress comes and changes it, right?
Right,
So
right.
projecting future tax rates is very difficult. So you have to know what your current tax rate is and then guess as to what your future tax rate is to determine whether or not a Roth 401k contribution makes sense versus a traditional 401k.
Yeah.
But most people are like, well, I'd rather get taxed now, tax the harvest versus the seed, that type of thing.
Mm-hmm.
But there's other factors in there. So, and I can debate all day about maybe it's better to just not pay taxes now and then kick the can on that and see what happens. Because you can always course correct later. But if you pay the taxes now at the higher rate, you might never recoup that benefit in your Roth, just as an example. But let's talk about health insurance subsidies. We've done shows on that. That is based on income, not assets. So if you retire and need to get your own health insurance and you want to qualify for health insurance subsidy, something that's very useful is free cash or a Roth IRA that you can take money from to live off of, because that's not considered income. And then
Yeah.
your subsidy's higher.
Yeah.
So using a traditional versus Roth
Depends on your
contribution
timeline.
discussion depends on your timeline. What's your retirement age?
Are you going
Will
to
you
retire
need?
before 65? Then that's
Yes,
a strategy you might want to employ. If you're going to wait until 65 or your full retirement age at 67, then it's not going to, that strategy doesn't, you don't need to worry about it because you're going to have
exactly.
Medicare and Medicare Advantage. So, yeah.
Or supplement, right? And
Yeah.
so your income, unless it goes Aunt Irma comes in, that's another factor, right?
Oof.
So we know Aunt Irma
Yeah.
is the Medicare surcharge for certain income. It's nice to have non-traditional IRA. A lot of people have just a lot of traditional IRA. It's just got filled with taxes. The IRS is waiting, and there's limited options they could do. Having some Roth is useful to
Yeah.
flexibility. Also, long-term capital gains rates. So this is gains that you hold on an investment for longer than a year, not in an IRA, are favorable. 0% for a big chunk, then 15, max 20%. So if you don't have any long-term capital gains, and if you did, you would pay 0% tax. That's pretty good. But you can have long-term capital gains if all your money is in a Roth or a traditional 401k IRA. This is for non
Yeah.
retirement
Which
funds.
the majority of the average Americans and middle class, all their money is in either a 401k, IRA, Roth.
Right.
Right.
Right. But wouldn't it be nice to have the $10,000 long-term gain outside of the IRAs, Roth or traditional,
Sure.
and pay 0% tax on it because that's what the tax bracket allows? Well, yeah, I'd rather pay 0% tax than any tax. Long-term capital gains cannot be overlooked. So when you're thinking about should I put into the traditional versus the Roth 401k, you also want to factor in, well, what about if I didn't put it into either and I just took the money and invested it outside to
But
build
there
up
are risks
long-term
with
capital
that. But
gains?
there are
Of
other risks
course,
that come with
right.
that. Yeah.
But this is a tax discussion, so you need to understand all the different tax brackets. You need to understand that Social Security income's taxed differently than ordinary income. Long-term capital gains are taxed differently than ordinary income or Roth contributions or distributions from an IRA.
Yeah.
And then finally, you got your RMDs, which stand for
Really massive donuts.
really massive donuts, or in the financial world, required minimum distributions, which is
Yes.
based on your overall traditional 401k
Yeah.
amounts, not the Roth.
And
So that's
traditional
another factor.
IRA. Yeah.
Right, right.
Traditional IRAs and 401ks or 403bs, the traditional retirement accounts, whether employer sponsored or a personal IRA, if they're traditional, you got to take required minimum distributions, right? At age what?
That's right.
73 is now the age.
Right. And so for many people that are working, especially those that are closer to retirement and are in the catch-up phase, traditional 401k makes a lot of sense because probably they're at a higher tax bracket than they'll be if they retire or when they retire.
Right. Right.
So this idea of forcing them, the catch-ups, to be put into a Roth 401k means they're going to be forced to pay tax now at their high tax bracket. So that's a negative if you look at it from that perspective.
Yeah. You have to do
But
the
at the same
math and
time,
Yeah.
It actually kind of forces people to add to a Roth where they may not have in the past, which will then add to the flexibility. So the answer, Tony, is you should have a combination of traditional and Roth so that you have flexibility to do what you need to do depending on what's going on at that time.
Ah, okay.
So saving for retirement helps in the long run. No one's going to dispute that. But what is the optimal mix between a 401k Roth versus traditional 401k? I can't answer that. That's going to be highly dependent on your situation, as we just talked about.
Right.
But for you, Tony, it doesn't really matter because you're just trying to skate by. And if you could just stop spending money on the records that are surrounding you
Ooh, yeah.
daily,
Oh, yeah.
that would be,
Yeah. Yeah.
then you
Yeah.
can start having
Oh,
big boy
oh,
discussions.
yeah. Granddaddy. Good album. We all
A
know
very
that.
good album.
Yeah. Yeah.
25-year anniversary on that one.
Yeah.
So I think this is um, at least the IRS has come up with the guidelines so that we don't have to go in the dark anymore.
Right.
But it adds a small window of opportunity for people in 2025 and 2026 to at least control their mix a little bit. But 2027 and on, you have no choice. Catch-up contributions will be into the Roth version of the 401k if you make above 145,000, which who knows if that'll stay at that rate. Maybe they'll lower that or raise that. Who knows? A lot of unknown, Tony, but more information is good. Taxes are bad. What can you do? You can only hope for the best, right?
Right. And work with a financial professional like yourself to make sure you have all the proper strategies in place for your personal situation. That's so important.
Ask your accountant, ask your financial advisor what you should be doing with your catch-up contributions. Should it be in a Roth? Should it be traditional? You got to have this conversation. Don't just go with the default because you could be making a mistake. You might be getting lucky. Who knows? At least have the conversation. That's what
Yeah.
I'm saying. So
Yep.
that's it, Tony. Thanks for a good show. And guess
Excellent.
what? Next week, I'm coming to you. Let's do this. We'll do a show together. How about
That'll be
that?
fun. Yeah.
All right. See you then, everyone. Have a good week.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Riddle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.